pretends it doesn't do it while doing it louder than anyone else. Europe does it accidentally, then pretends it was intentional. And emerging markets get crushed in the crossfire. Capital floods in, rushes out, currencies collapse, debt explodes, the strange part. Most of this happens while leaders stand at podiums saying everything is fine, because admitting a currency war is like admitting you're cheating in a game where everyone else is cheating too. It breaks the illusion, so the war stays invisible. And that's why this matters now, because the next global downturn won't start with a stock crash. It will start with a quiet decision in a central bank meeting room, a single sentence in a policy statement, and a currency that suddenly moves just a little too fast. That's the opening move, and we are already seeing the first pieces shift. To understand how currency wars actually work, you have to forget everything that looks dramatic. No tanks, no speeches, no emergency summits. It starts with something that feels almost boring, an interest rate cut. A central bank steps up to a podium and says the economy needs support. Growth is fragile. Inflation is below target. So they lower rates. Markets cheer, stocks jump. Headlines call it responsible leadership. But under the surface, something else just happened. Lower interest rates make a country's currency less attractive to hold. Investors earn less by keeping money there, so capital starts to drift away. The currency weakens. Quietly, politely. That's move one. Move two is even quieter. Money printing. It doesn't look like printing. No trucks. No presses. Just a few keystrokes at the central bank. They buy government bonds with newly created money that pushes interest rates down. Even more, it floods the system with cash. The currency weakens again. Still sounds technical. Here's what it really means. Your government just made your money less scarce, and when something becomes less scarce, it becomes less valuable. That's not ideology. That's arithmetic. Now zoom out. Country weakens its currency. Exports surge. Factories look busy again. Unemployment dips. Politicians smile. Country B feels the impact almost immediately. Their exporters start losing contracts. Their trade deficit widens. Growth projections get revised downward. So their central bank panic. Quietly, they cut rates too. They print too. Their currency weakens too. And just like that, the war spreads. No one announced it. But everyone is responding to everyone else. This is where it gets strange. Every country is trying to get richer by making its money worse. That sounds absurd. It is. But it works in the short term. And politics only thinks in the short term. Now add debt to the story. Most governments are drowning in it. And debt hates inflation, or rather, inflation loves debt. Because when prices rise, the real value of old debt shrinks. If you borrowed $1 trillion a year ago and prices double, you effectively pay it back with money worth half as much. So a weaker currency, higher import prices, higher inflation, suddenly that debt problem looks manageable, not solved, but delayed. That's the real incentive. Nobody likes to say out loud, currency wars aren't just about exports. They're about erasing debt without admitting default. It's financial anesthesia. Now layer in global markets. Trillions of dollars move across borders every day. Chasing yield, chasing safety, chasing returns. When one country weakens its currency, hot money leaves. It flows into the next place offering slightly higher rates, slightly stronger currency, slightly better stability. That pushes that currency up, which hurts that country's exports, which forces that central bank to cut rates, which pushes their currency down. It's a chain reaction, a global game of monetary whack-a-mole, and the people who get hit hardest, not governments, not banks, ordinary workers, savers, anyone paid in a currency that's being quietly sacrificed, because your salary doesn't reprice instantly, your rent does, your food does, your energy bill definite, illy does. And no one ever tells you it's happening on purpose. They just say inflation is complex. Supply chains, geopolitics, weather. Anything except the truth. that the value of your money is being negotiated in rooms you will never enter. And this system only holds together as long as everyone pretends it is. A war. But history says that pretense never lasts. Currency wars don't. Stay polite. They start quietly, technically, respectably. Then something breaks, because once everyone is weakening their currency, only way to win is to weaken faster. That's when central banks stop pretending. They go bigger. Rates drop to zero, then below zero. Yes, negative. You pay the bank to hold your money. It sounds like satire. It isn't. Japan did it, Europe did it, others are circling. The idea again, then comes the bigger move. Unlimited money printing. Not a billion, not a trillion. As much as it takes. That's not a metaphor. That's an actual phrase used by central bankers. And when you create unlimited money, you don't just weaken your currency, you send a message to the world. We will not lose this. Other countries hear that message loud and clear, so they respond. More printing, more stimulus, more rate cuts. The war escalates. Now here. The uncomfortable math nobody likes to show on a whiteboard. Global trade is priced mostly in dollars. Oil, shipping, food, debt. So when the U.S. weakens the dollar, every country using dollars to TIR, 80 or repay loans feels it immediately. Their import prices jump, their debt payments get harder, their inflation spikes. So they have to weaken their own currency just to survive, even if they don't want to, even if it wrecks their economy long term. That's how a currency war turns into a global contagion. And this is where the public story and the real story split apart. Public story. Central banks are fighting inflation. Markets are volatile. Growth is uncertain. Real story. Every major economy is trying to export its problems to everyone else. Because if your currency weakens and someone else's doesn't, you win. For a while. Now let's talk about the thing nobody likes to say out loud. Some countries can win currency wars. Most can't. The winners are ones with reserve currencies, deep financial markets, military power, political leverage. The U.S. can print trillions and still borrow cheaply. Japan can run 250% debt to GDP and nobody panics. China can control capital flows and move its currency when it wants. Emerging markets. They don't get that luxury. When they weaken their currency, investors run, capital flees, debt explodes. Inflation goes vertical. So they either defend their currency with high interest rates or they let it collapse. Either way, their economy gets crushed. That's why currency wars are deeply unequal. The rich countries throw punches, the poor countries absorb them, and there's another layer, speculators, hedge funds, banks, trading desks. They watch central bank signals like hawks. A hint of easing. They short the currency. A rumor of printing. They pile in. They amplify every move. They turn policy nudges into currency avalanches. So now governments aren't just fighting each other. They're fighting markets. And markets are faster, colder, relentless. This is why leaders keep lying about it. They say they support strong currencies. They say they don't target exchange rates. They say everything is under control because the moment people believe a currency is being deliberately weakened, they rush for the exits. And that turns a quiet war into a loud collapse. This is the trap once you enter currency. War, you can't admit it, and you can't stop. Not without blowing up your own economy. So everyone keeps going, printing, cutting, smiling at press conferences, hoping someone else blinks first. They never do. Now step back and look at the board. This isn't a short-term skirmish anymore. It's a structural problem. Every major economy is aging. Workforces are shrinking. Productivity growth is weak. Debt is massive. That combination is toxic because it means real growth. The honest kind isn't coming back the way it used to, so governments are stuck. They can't raise taxes without causing backlash. They can't cut spending without collapsing. Politics, they can't default without detonating the financial system. So they keep choosing the fourth option, quiet devaluation. Make the currency weaker. Let inflation do the dirty work. Shrink the real value of debt and pretend it's an accident. This is why currency wars are ending. They're becoming policy. And here's where it gets darker. The more this happens, the more unstable the system becomes. Because currencies are supposed to be anchors. They're supposed to be boring, predictable, when every major currency is being manipulated, aided at the same time. Nothing is stable anymore. Exchange rates swing wildly. Capital sloshes across borders. Asset bubbles inflate, then pop. And every time there's a shock, the response is the same. More printing, more easing, more currency weakening. It's not a solution, it's a feedback loop. Now add geopolitics, sanctions, trade wars, frozen reserves, weaponized payment systems. The moment the world watched a major country's foreign reserves get frozen, something snapped. Because that was the day money stopped being neutral. Every government quietly asked the same question. What if we're next? So now countries are stockpiling gold, building parallel payment systems, signing trade deals that bypass dollars. That's not about efficiency. That's about survival, which means the next phase of currency wars won't just be about exports. It will be about control over payment rails, control over reserves, control over who gets access to global money and who doesn't. That's a much more dangerous game, and it brings us to the part that affects you directly. If currency wars keep intensifying, three things become normal: persistent inflation, volatile exchange rates, financial repression. The last one is the quietest. It means keeping interest rates below inflation. So your savings lose value every year, slowly, reliably. It's not theft, it just feels exactly like it. And it's politically invisible because nobody ever votes on it. This is the long-term cost of permanent currency war. Not collapse, not apocalypse. A slow erosion of purchasing power. A constant sense that money doesn't work the way it used to. And here's the irony. The system was designed to prevent this. After World War II, countries built a global order to stop competitive devaluations. It worked for a while. Then debt got too big, politics got too fragile, and growth got too scarce, so the old rules quietly died. And no one announced the funeral, which brings us back to that factory floor. From the beginning, those lights aren't off because workers got lazy. They're off because exchange rates shifted, orders moved, capital flowed somewhere else. Not because of a war with bombs, but because of a war with spreadsheets. And the uncomfortable question isn't whether currency wars are still happening. They clearly are. The real question is this: when every major country is trying to weaken its own money at the same time, what exactly are we all racing toward? And what happens the day people stop pretending their money is still real?